The dollar just exploded higher and pound sterling to US dollar just printed its lowest reading in 18 months. But here's what the screens aren't telling you. The RSI on the daily chart is at 10.3. That is not a typo. We haven't seen oversold levels this extreme since October 2023. And that is exactly why the biggest opportunity, and the biggest danger, exist right now, at this very moment. There is one danger zone and one hidden opportunity right now. I'll show you both. Here's what I promise you. Stay to the end and I'm giving you 3 exact levels you can trade today, complete with entry triggers, stop losses, and risk-reward ratios. Here's the verdict on pound sterling to US dollar right now. The session bias is sell, until proven otherwise. But here's where it gets interesting. At 1.3282, we are trading at the absolute edge of the 4H demand zone, and we are staring directly at the 61.8% Fibonacci retracement level from the 2024 lows at 1.3260. That is the single invalidation level that flips the entire structure. Write this number down. If we break 1.3260 with a strong 4H candle close below it, the entire structure resets, and we are looking at a freefall toward 1.3200 and potentially 1.3150 over the next 48 hours. Now here's what the herd is doing right now, and this is critical. Retail sentiment data shows 73% of traders are long pound sterling to US dollar at these levels. I'm repeating that. 73% of retail traders are buying the dip. That is classic retail behavior, buying into a falling knife because it looks cheap. Meanwhile, institutional flows show asset managers reducing long exposure by 22% in the last week, and hedge funds are aggressively building short positions at 1.3350 to 1.3380. The smart money is selling, and the retail crowd is buying. That divergence is exactly where the next move is born. Let's zoom out to the weekly chart first. The weekly trend is a strong sell. Price action has printed 3 consecutive red weekly candles, each one closing below the previous low. The weekly MACD is showing bearish momentum with both lines diverging to the downside, and the histogram is expanding negative. I want you to look at this carefully. There is no bullish divergence on the weekly time frame. Not yet. That means the path of least resistance remains to the downside until we see structural confirmation of a reversal. Now let's move to the daily chart. The 50-day moving average is sitting at 1.3397 and the 200-day moving average is at 1.3407. Yes, those are nearly perfectly aligned. The daily RSI at 10.3 is the biggest story here. This is the most oversold reading since October 2023, when we had the UK bond market crisis. And that tells you something incredibly important. The selling has been aggressive, it's been sustained, and it's potentially exhausted in the near term. But do not confuse oversold with a bullish reversal. Markets can stay oversold for extended periods during strong trends, and that's exactly what the ADX at 29.68 is telling us. The trend strength is significant. Not extreme, but strong enough to keep the momentum going. The daily MACD is the critical piece here. The 12-day EMA is at minus 0.003, which is technically the zero line, and the signal line is falling rapidly. We have no bullish divergence yet on the daily. The price is making lower lows and the MACD is making lower lows, which suggests the bearish momentum is intact. Let's drill down into the 4H chart. The 20-period moving average on the 4H is at 1.3314, acting as dynamic resistance. The 60-period MA at 1.3337 and 200-period MA at 1.3359. We have a clear bearish crossover where the 20-period has dropped below both the 60 and 200. Classic death cross configuration on the 4H time frame. The 4H MACD is showing persistent bearish momentum, but this is where it gets interesting. If you look closely at the 4H chart, we are seeing a potential loss of downside momentum. The histogram is starting to show smaller red bars compared to the previous move down from 1.3400. That's a microsignal of exhaustion. Here's what most traders miss. The 60-minute chart shows we've just come off a sharp impulsive move down from 1.3320 to 1.3260 overnight. We've printed a bullish divergence on the 1H RSI, higher lows in price, higher lows in RSI. That's a classic reversal signal on the smallest time frame. But here's the trap. Divergences on the 1H don't mean anything if the 4H and daily are still screaming sell. What we need is a transfer of momentum. We need the 1H divergence to lead to a 4H base building, and then to a daily bullish crossover. The 1H moving averages are all pointing down, MA5 at 1.3317, MA10 at 1.3348, MA20 at 1.3374. We are trading well below all of them. The CCI at -279 is showing extreme selling pressure, and Williams %R at -29.9 is confirming oversold conditions. But again, oversold is not a buy signal. It's a caution signal. The pivot point at 1.3300 is the level I'm watching most closely right now. This was yesterday's settlement level and psychological resistance. If we trade above 1.3300 and hold it on a 1H close, that's the first sign of a potential short-term bottom. Clear support levels. S1 at 1.3260, S2 at 1.3240, S3 at 1.3200. Clear resistance. R1 at 1.3320, R2 at 1.3360, R3 at 1.3380. The 1.3260 to 1.3320 range is the battleground for the next session. A break below 1.3260 opens the trapdoor to 1.3200. A break above 1.3320 suggests a potential squeeze to 1.3360. The core fundamental driver behind today's move is simple and it's powerful. Yesterday's Fed decision changed everything. The Federal Reserve held rates steady at 5.5%. That was widely anticipated. What was not anticipated was the updated dot plot projection for 2026. The Fed now expects one additional rate hike later this year before even considering cuts. That's a hawkish surprise that sent the dollar index surging above 105.50. The market reaction was immediate and brutal for the pound. Pound sterling to US dollar gapped lower overnight from 1.3370 to 1.3280 on the back of this news. The US 10-year Treasury yield spiked to 4.45%, while the UK 10-year gilt yield sat at 4.28%. That yield differential is now 17 basis points in favor of the dollar, representing a significant carry advantage for USD longs. Here's the narrative web you need to understand. The Fed's hawkish stance is rooted in persistent inflation. Core PCE is still above 2.8%, and recent data shows wage inflation remaining sticky at 4.2%. Meanwhile, the Bank of England faces a very different but equally challenging problem. UK CPI is stuck at 3.6%, well above the BOE's 2% target, but the UK economy is showing clear signs of slowing. The BOE is trapped between the inflation dragon and the recession dragon. The market is expecting the BOE to hold rates at 4.75% in the next meeting, but the key variable is the vote split. If we see a 7-2 vote with 2 members voting for a cut, that signals dovish pressure building. If we see a 6-3 vote for a cut, that would be outright dovish and could send pound sterling to US dollar down another 100 to 150 pips. The BOE's decision is the single most important event for pound traders in the next 2 weeks. Cross-asset linkage is crucial here. Look at euro to US dollar. It's down 0.9% today, showing broad dollar strength. The dollar index at 105.50 is putting pressure on every major pair. The correlation between pound sterling to US dollar and the S&P 500 has turned positive again, with risk-off sentiment driving both dollar strength and equity weakness. If the S&P 500 breaks below 5,200, expect further dollar strength and pound sterling to US dollar to follow lower. Over the next 1 to 2 weeks, the directional lean is clear, bearish until the BOE provides a clear dovish signal OR until we see a meaningful capitulation in the dollar. The event that invalidates this view? If the Fed speakers start pushing back against the one-hike projection, that would cause a repricing and send pound sterling to US dollar back toward 1.3400. Also, any hawkish surprise from the BOE would shift the narrative. Do you think the dollar breaks 105.50 this week? Comment yes or no. I'm tracking consensus and I'll share the results in my next breakdown. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to give you 3 trade setups with exact numbers that you can execute immediately. Strategy 1, the sniper, conservative. This is the high probability fade trade for those who want to trade the oversold extreme with institutional risk management. The setup triggers ONLY if we get a 4H candle close above 1.3300. That's the pivot point that broke yesterday. A close above 1.3300 tells us the immediate selling pressure has exhausted and that we might see a short-term mean reversion toward the 20-period moving average on the 4H. Entry trigger. 4H candle close above 1.3300. You enter at market on that close, or you can enter at 1.3305 with a limit order stop loss, 1.3260, exactly 44 pips below entry. Why 1.3260? That's the major support level and the 61.8% Fibonacci retracement. If we break 1.3260, the entire long thesis is invalidated and you exit immediately. Target 1, 1.3360. That's the 50-day moving average and the R2 resistance level. This gives us a 1 minute and 1.3 seconds risk-reward ratio. Target 2, 1.3380. This is the R3 resistance and the 200-day MA. This gives us a 1 minute and 1.8 seconds risk-reward ratio. This setup is voided if we see a 4H candle close below 1.3260 before our entry. If price breaks 1.3260 first, this setup is dead. Don't even think about it. Wait for the next signal. The sniper, conservative, entry, 1.3305, 4H close above 1.3300, stop loss, 1.3260 take profit 1, 1.3360 take profit 2, 1.3380 risk, reward, 1:1.8R invalidation, void if 4H candle closes below 1.3260. Strategy 2, the active trader. Standard. This is for the traders who want to follow the current trend and sell the rallies. The institutional approach to a strong trend with oversold bounces. The setup is a pullback trade. We are looking for price to recover toward the 1.3320 to 1.3330 zone, which is the 50% retracement from the overnight drop and the 20-period moving average on the 4H. You enter on a bearish rejection candle, a shooting star, bearish engulfing, or a doji with a long upper wick that forms in that resistance zone. Entry, 1.3325 on bearish rejection confirmation. You can also enter with a limit order at 1.3320 after a confirmed rejection. Stop loss, 1.3360. This is 35 pips above entry and represents the 50-day MA. If price breaks above 1.3360, the selling thesis is damaged, and we could see a much larger squeeze. Target 1, 1.3260. This is the major support level and your first profit target. This gives us a 1 minute and 1.8 seconds risk-reward ratio. Target 2, 1.3240. The S2 support level. This gives us a 1 minute and 2.3 seconds risk-reward ratio. Trailing stop rule. Once target 1 at 1.3260 is hit, you move your stop loss to break even, 1.3325, to protect your capital. Then you trail the stop behind each 4H candle high to lock in profits as the trade continues lower. This setup is voided if we see a daily close above 1.3360. That would signal that the bulls have taken control and that the bearish trend is breaking down. Type your pound sterling to US dollar range for tomorrow in the comments now. Let's see who's aligned. The active trader, standard, entry, 1.3325, bearish rejection confirmation, stop loss, 1.3360 take profit 1, 1.3260 take profit 2, 1.3240 risk, reward, 1:2.3R invalidation, void if daily close above 1.3360. Strategy 3, the aggressor, high risk. This is for the traders who are willing to countertrend trade the immediate oversold extreme with a tight stop and quick target. only for those who can lose small and manage risk aggressively. The setup is a direct reversal trade at the 1.3260 support level. We are betting that the extreme oversold conditions will cause a violent short-term bounce from this key Fibonacci level entry, 1.3260, if we see a bullish 15-minute candle close above the session low. This confirms rejection from the support level. You enter at 1.3265 on the candle close, stop loss, 1.3240, only 20 pips below entry. This is the S2 support level. If we break 1.3240, the trade is dead and we are likely heading to 1.3200 at target 1.3305, 45 pips above entry. This is the pivot point and resistance. This gives you a 2.25 to 1 risk-reward ratio target to 1.3325, 60 pips above entry. This gives you a 3 to 1 risk-reward ratio explicit warning. This is a counter-trend trade in a strongly bearish market. The probability of success is lower than the other two setups. You must risk no more than 0.5% of your account on this trade. If it fails, you take the small loss and walk away. Do not add to losing positions. Do not hold this trade if the 4H trend starts accelerating down the aggressor, high risk, entry. 1.3265, 15M bullish candle close, stop loss. 1.3240 take profit 1. 1.3305 take profit 2. 1.3325 risk, reward. 1:3.0 are invalidation. Void if 15M candle closes below 1.3240. Never risk more than 1 to 2% per trade. With these setups, your stop losses range from 20 to 44 pips. Calculate your position size accordingly. No positions through tomorrow's US PCE data release. Stops are non-negotiable. If price hits your stop, accept the loss and move on. This is how you survive to trade the next big move. The market will always give you another opportunity. Don't force it. Let's summarize the most critical level for the next session. That level is 1.3260. Everything hinges on this number. If we hold above 1.3260 and print a bullish 4H close, we could see a relief rally to 1.3320 and possibly 1.3360. But if we break 1.3260 with conviction, meaning a 4H candle close below it, you want to be short, targeting 1.3240 and 1.3200 with trailing stops. Tomorrow's focus is the US PCE data release at 8:30 a.m. Eastern Standard Time. This is the Fed's preferred inflation measure and will be a massive volatility catalyst. If PCE comes in hot, expect the dollar to rally further and pound sterling to US dollar to test 1.3200. If PCE misses lower, we could see a significant dollar sell-off and a squeeze in the pound toward 1.3400. If you want the full breakdown on the S&P 500 and its correlation with dollar strength, that video is live now. Tap the end screen. I covered exactly how the Fed's hawkish shift is impacting risk assets and why the S&P 500 might be the leading indicator for USD strength. Smash like if this gave you a clear plan for pound sterling to US dollar. Subscribe, hit the bell, and I'll see you in the next one.